Okay, good morning, everybody. Welcome to today's webinar with CCI Traders. My name is Mark Sapsford. I'm broadcasting live from London. So, welcome to everybody. Can I just ask a quick question just to make sure that you can hear me? If you can just put a little chat message up to make sure that you can hear me clearly, and then I can get started. Fantastic. Thank you very much. So, what I'm going to do is I'm just going to wait a minute or two and chat with you because we've got a few people still signing in by the looks of it. We've got quite a few people logged in already. So welcome. Welcome to wherever you are in the world. I'm expecting people from all over the world today. This is the second webinar that we've done with CCI Traders. And if you tuned in last time, which was last week, you would have seen the webinar was all about trading psychology. So how to build a good trading psychology, what the trading psychology steps are to ensure that you can trade safely, but don't get involved too much with the emotional attachment to it. So you may recall during last week's webinar that I said this week we're going to talk a bit about trading strategies and how we can create a trading strategy from scratch. So, bearing in mind the issues we had last week, now the first thing I'd like to say to you all, guys, is if you're watching, and some of you are watching on a mobile, you will get a bit of a lag. So, you'll get a bit of a lag behind. Also, if you're watching on a laptop or a desktop, can I ask you to close down any other tabs? Because what tends to happen, and we had this issue last week with regards to the webinar crashing, it crashed a couple of times, and it can be caused, I've spoken to technical, and it can be caused by too many tabs being open on your laptop, which can cause freezing, etc. So if you can make sure you've got other unnecessary tabs closed. And what I have done as well is, just so you know, is I've pre-recorded some of this webinar. So it's useful information today about trading strategies and how to create one. So I'm just going to talk to you a little bit for the first few minutes while we're waiting for everybody to arrive. We've got more and more people arriving, as I can see, which is great. Let's see where we've got people from. Okay, fantastic. All over the place. It's really good. It's encouraging to see we've got people tuning in from all over the world today. That's really, really good. Okay, so we've got a nice number building up now. We'll just give it another few minutes and then we'll get started, and I'll get started with the first section. So today what I'm going to do is I'm going to talk to you about a trading strategy. What the first part of the webinar is going to be what a trading strategy is, and then the second part is what you can do and what steps you can follow to actually create a strategy yourself. So let me just amend that. Fantastic. Okay, and I'll say we're getting people coming in by the droves. We are starting these at 9 o'clock, guys. So when you get your link, so just another piece of housekeeping for you. When you get your link through for the webinar for the next one, you can register straight away. So you can register straight away, which will put you in a virtual lobby, and then you're already there waiting. So we can see how many people are registered for it. And that way we can then get you started at 9 o'clock on the dot. If you start registering at 9, it does take a little few minutes afterwards to actually get you guys get into the room and stuff. So if you get the link, once you get the link over the next few days for the next webinar, then just make sure that you get yourself clicked on it. So before I start, I just want to talk to you a little bit about CCI Traders. So CCI Traders have put a couple of bonuses together for you. The first bonus is for the education. So those of you that watch the webinar, you need to send an email. I just need to share my screen here. And where with me? And I'm going to give you an email once I can find it. There, you should be able to see that email address there. You should be able to see that. support@ccitraders.com. So if you send an email to that email address, once you've registered and watched the webinar, you will receive a $50 bonus into your trading account. So open your trading account and you'll get $50 put in, which is for you to trade with on your first trade. So that's a really good bonus for you and encouraging you to watch the education that we're doing over the coming weeks. Also, remember, for new people, new clients as well, we've got a little, let me just get rid of that. Don't need that anymore. Also, we've got a new client bonus, which is this. Okay, so you should be able to see that up on the screen. Get 50% bonus on your first deposit. So hopefully you can see that little poster there. And again, that's going to be given to you guys on your first deposit and 50% bonus of your money. So a good bonus to get people started with trading. Okay, so you should be able to see the poster on your on the screen now, which is a 50% bonus on your first deposit. So we're getting a few more people coming in now. So in a moment, I shall start the content. Okay, fantastic. So trading strategy and trading strategies and how to create one. So as I said, I'm going to do this in two sections. The first section is going to be all about what a trading strategy is. And the second section was going to be how to create a strategy. I will stop in between for questions, and I'm just going to play you the first section now, which is what a trading strategy is. And I want you just to make sure and send me a quick message to say that you can hear me. If you can't hear me, make sure your volume's turned up, because I'm getting most people can say yes, they can hear clearly, but one person said no, so I presume you've got your sound turned down. So let me get the first part up. So today we are going to cover off two topics. One is what is a trading strategy, and also I'm going to show you how to create one too. So in this section, the first section is what is a trading strategy. Trading is very simple, yet it's not easy. Many people have said to me, is trading an easy thing to do? Well, it's not. And I'm sure those of you that have traded before have realized that it's not easy. But it's very simple. Unfortunately, some of us make it not so simple. People start off falling by the wayside very simply because they use guesswork. So when they're trading, they don't have a structural approach. They just guess where to get in and where to get out of the market. If guesswork is used, it's virtually gambling. So they're gambling with where to get in, where to get out, and with no rhyme nor reason and no structure to it. Those who do this will invariably either lose trades and don't know why, or even worse, lose most of their money or all of it. Really damaging. So why does it happen? Why does this happen? Well, sadly, many people enter trades into the market because they thought it was the right time. And often this is because it was just a hunch or a guess. They just thought that the trade was going to go that way, or they thought the trade was going to go this way, and they got in at the wrong time, or it was just a simple hunch or a guess. When this happens and the trader enters the market, often at random, anything can happen, and that's literally anything can happen. Markets can go all over the place, the trader doesn't know where they are, and it gets a complete mess. Even worse than placing a trade at random for no particular reason with no structure or strategy is the fact that the trader probably doesn't even know where to get out of that trade to stop any damage that's happening. Top investors and self-driven and self-funded traders all know when they are going to enter a market and when they are going to exit a market before actually going in. This is called a strategy. So let's look at the definition of the word strategy. A strategy is a plan of action designed to achieve a long-term or overall aim. Strategies also happen elsewhere in the world. They are used all over the world in various different environments. The most important and crucial events in the world cannot function effectively without a strategy. The art of planning and directing overall military operations and movements in a war or battle is a strategy. So this is just as important for traders when they are playing with their money. You're playing with money, you're investing money, hard-earned cash. Traders are putting into an account money they may have saved over years. So having a strategic approach to it, rather than gambling, is so much more sensible. So what is a trading strategy? A trading strategy is, in essence, a set of rules created for the trader to follow. Whether this is one set of rules or more sets of rules, an individual trading strategy is a set of rules created for a trader to use to get into the market. These strategies, these rules must be stuck to rigidly, to the T, to the letter, to the nth degree. Failure to stick to all the rules invalidates the strategy. Let me give you something that's a very similar environment to using rules. Somewhere where we use rules but don't really need to think about it. Let's take crossing the road. When we cross the road, we look left, we look right, we look left again and right again to make sure it is clear to cross and safe, and we cross. The reason we do that is because if we don't do that, there are consequences which could cause danger for ourselves. Now, as we go on through life, when we're a child taught the Green Cross Code, here in the UK we have the Green Cross Code. I'm not sure if you have that around the world, wherever you are in the world watching this, but we have rules that we teach children how to cross the road safely. And until they can demonstrate they can do it, we don't let them out of our sight on roads as adults. Trading is the same. A set of rules created to follow. Failure to stick to those rules will A, invalidate the strategy, and B, prove that it's no longer a strategy. But why is that? Well, this is where B comes in. A, it invalidates the strategy, but B, it's back now down to guesswork. Is it safe to cross the road? Well, we don't know. We're not going to look. We're just going to take a risk, take a chance and cross. If there's something coming, there's something coming. If there's not, there's not. You would never do that. But if there's not, there's not. You would never do that. All strategies will have a success rate. Again, if the strategy is invalidated, so is the success rate. So unlike crossing the road, where you should have a 100% success rate, if you don't, you won't be here watching this video, you have a strategy in trading that doesn't always have a 100% success rate. No strategy can. No strategy does. But if you don't follow the strategy, then you've invalidated the terms of that strategy that you've created and also the success rate as well. So why do traders not use strategies? Strange, crazy, isn't it? So let's explore the reason for that. First of all, impatience. Waiting for the rules to be met and to place the trade, which can be a long wait. If you're waiting for a specific criteria for your rules to be met in the market, it can be a long wait because your criteria could be too tight, or your criteria could be just that these strategies only set up every now and then. And if you're not watching your charts, how do you know if it's going to be setting up? So it can cause impatience, and therefore traders say, well, what's the point of a strategy? I'm waiting forever. I want to trade. I'm a trader. I want to trade. So impatience is a big thing and a big reason why some traders don't use strategies. The excitement gets the better of them. They just want to trade as and when they want. So they live on their edge. They live by the sword. They don't have a problem with adrenaline. They don't have a problem with, just trading for trading's sake. Because trading's exciting, seeing things go up and down in value. But in the cold light of day, obviously, if you're trading without a strategy, your chances of success are pretty much slim because you're just gambling and guessing. When a strategy has a run of losing trades, a trader can lose interest and belief in that strategy and therefore resort back to guesswork. Another reason why traders don't actually use strategies, which is crazy. The lack of belief, as we've mentioned, they just rely on their intuition or their perceived intuition and guesswork. Listening to other people as opposed to thinking for themselves is another reason why traders don't use strategies. Why should I use a strategy when I've got professionals and other people around me telling me what's happening in the market? What I do is I call this the Goldman Sachs approach. You all know of Goldman Sachs, but let me explain what I mean by the Goldman Sachs approach. The Goldman Sachs approach. Let's talk about Goldman Sachs. They are an institution. They run masses of hedge funds. But many institutions, just like Goldman Sachs, don't just trade and move the markets. They also have a contribution to make to media broadcasting. Many of the big broadcasting companies all over the world, wherever you are, will have Goldman Sachs on there being interviewed, or any other institution. It could be Deutsche Bank, it could be Barclays Capital, it could be Berkshire Hathaway, it could be anybody from a massive institution that's going to be contributing to media and broadcasting that media out to the public. They of course have an idea and a sentiment as to where the markets are going, because that's why they're there. They're being asked, what are their views? What is their sentiment? And because they are market movers, they know this, because they are the people with huge funds that drive the markets in certain directions. But they aren't shy of announcing things on the media. They're not shy of actually saying where they believe things are going to go. Many traders have heard on TV or other media Goldman Sachs speaking about their views on where markets are going. A trader then will listen to this, they'll absorb it and copy the sentiment. Not using a strategy, just using someone else's opinion. Then they place the trade. So they actually listen to what's been said to them, they absorb it, and then they place the trade. And for this example, they heard Goldman Sachs say they believe gold is going to go up in value over the coming period, so I'm going to get long on gold. Then they try to enjoy the ride from the indicator or the indication, I should say, from true professionals like Goldman Sachs. However, it soon becomes apparent that something isn't right. Something is very wrong. Gold isn't actually going up in value, it's selling off. The trader now has nowhere to go. Remember from the first webinar we did, if you were with us, the emotion side of trading psychology. This is where that kicks in and causes a whole host of other consequences that can kick into play. Damage limitations kick in, and they either close it all down or add more when it starts to turn. And this is really damaging because they've just listened to someone with an opinion. Total chaos ensues with no comeback, and the buck stops with the traders. Now, why is this, do you think? Well, Goldman Sachs, although they're a market mover and a massive institution, and I'm not saying they have deliberately misled by their statement, are just one of many big institutions. And although their views may be that gold is going to go up in value, the fact of the matter is that gold, because of other market movers and the market consensus was it was selling off. Goldman Sachs don't get it right all of the time, so how can we expect to get it right all of the time? We just have to increase our probability that we are going to get it more right than wrong, more times than wrong, if that makes sense. Again, no strategy, just someone else's opinion. So why do traders not use strategies then? Let's look at this. Well, another major reason is traders don't use strategies because they don't know how to create one. Now, if you don't know how to create a strategy, how the hell are you going to use one? So it's easier not to, and that's a real big part of trading. So for the second part of this webinar, I'm going to teach you how to create a strategy so you can do this yourself and you can then create your own strategies moving forward. Now on later videos and webinars, I'm going to be covering off indicators which can be part of your strategy process, but I'm going to teach you that on the second part of this webinar. But before I do that, does anyone have any questions? If so, I'm going to nip back to the portal and just check. So, hi everybody, I'm back. So in that video, what I showed you was what, in essence, a strategy is. Now, strategy can work on various different uh, environments. You know, it's something businesses have strategies, governments have strategies. So in that, you would have learned that what a trading strategy is. In regards to trading the markets. So before I go on to the next section, does anybody have any questions? Please fire any questions across about strategies. Now would be a good time for you to do that, purely and simply because if you have strategies that you use and you now maybe want to adapt those, or you may want to get into writing your own strategies, it's a really good way of you actually moving your trading forward, because trading strategies are what sets professional, successful traders apart from those that don't make money. And that's the difference. And trading is all about keeping you trading for a longer time. Because, you know, as a trader, you want to be somebody that is looking to have a positive reward to risk. And I'm going to cover that off on another webinar. So we've got a question coming. Can there be a strategy that cannot fail? Well, let me explain what I perceive that question to be. But if you can ask me another question, are you talking about 100%, or are you talking about cannot fail overall? Because in my opinion, there is no such thing as a strategy that has a 100% success rate. I've never seen one. Although people have spoken to me over the years, and I say I've been trading and teaching people for, this is in my third decade now of teaching people how to actually trade and make money from this business. I've never met anybody that's actually run a 100% successful strategy. However, many people have said and claimed they have one. But when you dig beneath the surface, the trading strategy they're running has zero risk management. So it just keeps it running until it does become a winner. And the problem with that, of course, is margin, because we're trading on margin. And if you just let a trade continue to run into a loss to later become a winner, you're in trouble, because your margin is going to get eaten away. So to answer your question, my friend, and I can't see your name actually, Mickey, can there be a strategy that cannot fail? The answer to that is really no. There is no such thing as a strategy that cannot fail. You will have losing trades. You will have strategies that sometimes have a dip down. The real answer to that is going to be on another webinar when we talk about risk management and how to control that. But in essence, you need to make sure that your strategy has a good, positive success rate. But also, you need to make sure that you are aware that strategies sometimes can give you losing trades. And I'm going to cover a little bit more of that off in a later webinar on risk management. So I hope that answers your question. Does anybody else have any more questions before we move on to the next section? Please feel free to fire them across. We don't have any more by the looks of it at the moment, but hopefully that answers your question. If it doesn't, then ping me across another question and I'll gladly answer it at the end. We'll do a Q&A at the end as well. So for some of you that have just joined halfway through that, we're doing this in two sections today. Some of it's pre-recorded. This is live right now, purely and simply to put less strain on the internet. And I'd suggest you close some of your tabs down. Those of you that are trading with CCI, which is all of you, all around the world, what I would suggest you do is, if you haven't yet opened an account, get one open. Fund it with as much money as you possibly can. If you want to ask a question about how much to fund, then that's fine. I can help you with that. And if you want to then look at taking advantage of the bonus offer, there's a 50% bonus offer for new clients, which is fantastic, and a $50 bonus for those of you watching this webinar. What strategy is good? Can you recommend? Well, that's a great question. It's the same person asking the question, Mickey. I'm going to cover that on webinar 3. So on webinar 3 next week, and I was going to cover this off at the end today and explain what's happening next week, but webinar 3 is trading ideas and indicators and how to use them. So next week's webinar is all about how you can put together different trading ideas and indicators and how to use those indicators and things that I do. The things that I use. For example, I'm going to show you a strategy example in a moment of when we how to create a strategy. I'm going to show you how I create one of my strategies on the screen in a moment. So what strategies good can you recommend? Yes, I can. But the best advice I can give you is education. Education, and get yourself armed with all the information you need, all the education that you need, so that you can have the knowledge to go away and use various indicators to know how they work and move yourself forward. So again, next week's webinar is very good. How do I open an account? That's from William. So William, the best way to do that is contact CCI Traders, support@ccitraders.com, and they will help you open an account. In fact, I'll type that up on the screen at the end of the webinar so you can get that. So open an account, ccitraders.com, and the amount that you trade, if you've got money to invest into your CCI Traders account, make sure A, you know what you're doing, B, you've got a good knowledge and education, and get your account funded, because there is lots of good opportunities around in the marketplace. And most importantly, if you put money into your account, you're going to get a stronger return than if you put your money into a bank or anywhere else. Trading is a great investment because of the returns you can make as compared to other investments out there and other banks, etc. So hopefully that answers your question to William. So I'm going to play now the second section of the webinar. We've covered what a trading strategy is, or what a strategy is as well. Now this section is all about how to create one. So let me just bear with me and I'll get it up for you. Okay, so let's talk about now how to create a strategy. We're talking specifically now how to create the elements you need to make a strategy, as opposed to what a strategy is. So we now know what a strategy is. Let me now show you how we can create one. Trading strategies require various elements to be effective. If you miss any of these out, then the success rate reduces dramatically, or it reduces even down to zero. It could be a complete losing strategy. It can be completely catastrophic if you miss out the vital elements that you need to have in a strategy. So the elements that you need include the following: where to enter the market, where to exit the market, risk management, and is there anything that may cause your trading strategy to become less effective individually or overall? And of course, what instruments are you going to trade with your strategy? There are many different instruments to choose from. More and more are being added all of the time. First we had equities, then we had forex. Now we have commodities and indices. Cryptocurrencies became a new kid on the block. And what's going to happen moving forward? Will we be able to trade the price of water moving forward? Price per litre of water. Will water become a commodity as it becomes scarce and goes up and down in value? Interesting, hey? So these are the elements you need to build your trading strategy. Let's see them bit by bit under a microscope. So let's look at this chart. As you can see, we've got a chart here, and the chart we have got here is a chart on euro against the dollar on a 15-minute time frame. Very simple chart. We have our dates and times across the bottom, and we have the price level that was hit, and obviously these candlesticks are using or showing you the price that it was hit at various times and various days in the past. So it's a basic chart, and it's a basic standalone trading chart. Let's look here where price is going up. So if you were buying here, price is going up in value, you would be making a good profit. If you were selling here, obviously you would be losing money. Here, as you can see, price is now going down. So price has gone up and price is going down. And that's typically what happens in a price chart. How do we know then, therefore, where to enter the market? So in real terms, it's so easy to look at a chart and really look at a chart and say to yourself, I want to get in here, or I want to get in it there. But we need to know where the probability is. So when we go into the market, we know exactly what we are doing has a risk attached to it, but also a calculated probability that the market is going to do what we want it to do. So we need to know where to enter the market. We need to know the background behind that, which is part of our strategy. So it's the same chart. Price is going up and price is going down. But what I've added now is I've added a red line. And this red line is called a moving average. Now it's the first time I've introduced indicators to you, and there is a later webinar going to cover indicators in great detail, how to add them to your charts, how to use them, how to read them, etc., etc. A moving average, in essence, measures the average of the last X number of bars. And in essence, they are really something that give your trading an edge. So moving averages show you what price is doing. So here you can see the moving average is facing up, and as price starts to fall, the moving average starts to fall as well. And the positioning in relation to the price as well. So quite often when moving averages are below price, price is going up, and when moving averages are below the price is going down. So you can see here we have the red line. It's a 50 moving average that usually is red, and it's measuring the average of the last X number of bars, in this case 50 bars or candles. So how do we actually know where to enter the market? We still don't know. So we've got the same chart again. Price is going up, price is going down, etc. And we have our moving average. We've now plotted a second moving average, and now things become a little bit clearer. We can see that we've got a red and a green line, and there are two different lengths of moving average crossing, and then that shows us the direction. So basically we have two moving averages here. We have one, which we said earlier could be a lower time frame, which is 50, for example, and we have the higher time frame, which is the 200. Notice how the two switch places. Here one is above the other, here one is below the other. And these are what we call crosses. So you can see that the moving averages have crossed. The shorter one with the lower number has crossed below the longer one, which is the higher number. In this case, it's a 50 and a 200. So now we have some sort of indication of where price is starting to move and where we could potentially see an entry price and an entry point in the marketplace. So you can see here, this is what we call a moving average cross. So it's the first element of a potential trading strategy. We have two moving averages crossing each other. the shorter one below the longer one, or the shorter one going above the longer one for a buying trade. So if this particular strategy was the opposite way around, it would be a buying trade when the 50 crosses from below. So if this green one was a little extended here, you could see here where we'd have the cross up to capitalize on this move here. So crossing of moving averages give us a good way of identifying where to enter the market and the first part of our trading strategy. Now there are loads of indicators you can use other than these, and I'm going to cover these off in great detail in other webinars moving forward, so please make sure you stay tuned and watch those. So we aren't guessing, we are using an indicator to indicate the probability of what may happen moving forward to price. There are many indicators for traders to use, and as I said, I'm going to cover more of these later in later webinars. So again, we'll send the links out to you, so please get yourself on these other webinars. There's real good value and real good useful information in them. But now you have the first part complete of your trading strategy, where to get in. So we're using various indicators, in this case 2 moving averages crossing, to work and calculate where we are going to enter the market. The first question has been decided: where do we enter? But where do we exit? And there are a number of ways you can look at where to exit the market once you are in. The traders can use a predetermined target in a price level, specifically a number of pips. So often when I'm trading, I have a trading strategy and I'll have a target of say 45 pips, which means once the target has been hit, my trade closes. It's exited. So we can use a predetermined target in a number of pips or a specific price level. So for example, if we are selling euro dollar and it's currently at 1.1050 and we want to close it when it gets to 1.1000, that's 50 pips, and we know we can put that level in, say that's our target. The other way you can do this is you can use when the moving averages cross the opposite way. Let me show you what I mean by that on the chart we looked at earlier. So as you can see here, the price is falling, the moving averages have crossed, and the red is going below the green, etc. And eventually at some point the red will cross back above the green. And at that point you could close the trade. So you wait for that point to happen, and then you do the opposite of when you went into the trade. You then close the trade by the opposite cross around on the moving averages. Again, it's a really valid way of exiting a trade. You could have a monetary target. So literally when you make say a couple of $100 on this trade, you're out and you want to close it, and you sit there and you wait for that to happen and you close your trade. Or just let it run. Letting it run again, is okay, but the thing is, if you let it run, when does it eventually turn back round again? So always try and have some sort of target in place rather than just letting the trade run. So let's talk about the most effective of these ways to exit the market. The first way is a specific take profit target. This is my preferred way of trading, having a specific profit target in a number of pips. So important. But also the opposite direction cross can really help as well, because the opposite direction cross, so if you have the red moving average crossing down below the green and then the red crossing up above the green later, you know that that move is probably coming to an end because the market is starting to go back up again. So you can use that to get yourself out of the trade. But what happens when neither of these happen for a long time? And that is the problem that frustrates traders. They take a trade and neither the profit target is hit or the green crosses the red doesn't happen. Or whatever the opposite condition for the indicator is, it just doesn't happen. So what would happen then if neither of those happen for a long time? And that's usually because the trade is going in the wrong direction. It's not falling. Although the moving averages may have crossed, it falls a little bit, then it goes back the opposite way. So this is where risk management is so important. And risk management kicks in at this point to help you. And I'm going to cover risk management off in detail on another webinar. Again, keep your eyes peeled for these webinars. There's a few of them coming up, and they're really useful to get your knowledge of trading and get your bare essentials needed so you can trade effectively. Every trader, you should use a negative exit point. So not only just using a position where to get in, but where to get out if things go wrong. So not just to get out if it goes well, but if it goes wrong. You should always have some sort of get out of jail card, or a point B, which is your support if it all goes wrong. Every strategy a trader uses must have a negative exit point. The point in which enough is enough, and when the trade goes the wrong way. Remember, you aren't going to win all the trades. In some cases, and I'm going to talk a little bit in another webinar about risk management and how you can have strong reward management. Some cases you may have more losing trades than winning trades, and that can be something difficult to comprehend. But when your reward to risk is high enough, it can really be a big way of really growing your account quickly, and I will cover that off in another webinar. So remember, they don't all win, so we need to have something there to protect us when we have trades that don't go in the direction we want them to go. It's called a stop loss. We use a stop loss on every trade. We call it the trader's friend, because it is the trader's friend, because a stop loss is there to protect you from losing excessive amounts of money on an individual trade. Some traders, believe it or not, still don't use stop losses. It's dangerous. It's like falling out of an aeroplane without a parachute. It really is. It really is that dangerous. A stop loss is the opposite of a take profit target. So for example, if you have a target, and let's show you the chart again. Let's say you have a target of down here somewhere of say 30 pips, and your entry price was here, then your stop loss would be up here somewhere, protecting you in case the market did turn and go the opposite way. It's as simple as that. A stop loss is there to protect you, and it's there to protect you from losing excessively, and it's there as the opposite side of a take profit target. So if you're selling, it's above, and if you're buying, a stop loss will be below. It's where the trade will stop if it goes wrong, and is usually, and I will cover this in the risk management section of a webinar later in coming webinars, is a specific percentage risk of your account and will be a number of pips from your entry point. But as I say, I'm going to cover more on that risk management in a later webinar. So what else do I need to take into account in order to create, but more importantly, use my strategy that I'm creating? We need to look at news. We need to look at what news is coming out that could affect us. Strategies are often completely almost useless when bug news releases are made throughout the world. Now, I've deliberately put the word bug here because I believe news releases to be that little bug that's flying around in the air going buzzer, 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 buzz. And it's actually annoying when you want to try and swat a fly, or there's a buzz bee running around, or a wasp. All these little things are annoying to us. And news releases are annoying to traders. And I'm talking about successful traders, because successful traders use strategies. And strategies are often useless when bug news releases come out, because the strategies are overridden by news releases that drive the market very strong, and I'm going to cover more on that a little bit later. However, these news releases, and I will just cover them off briefly, are economic data releases, things like interest rates, things like GDP, things like unemployment figures, things like purchase sales, house price index, unemployment claims. All of these things around the world in various countries will be economic data releases and released so the market can react, and it causes markets to move very sharply. Political announcements. When our politicians speak, political announcements. Wherever you are in the world, you'll have a political leader. So if you're somebody watching this webinar in America, fantastic, you've got Donald Trump and you've got the other politicians there talking about what's happening in the economy or what's happening domestically. And that can cause shockwaves in the economy and the rate of the dollar. You've got Europe, you've got Africa, we've got Asia, we've got Australia. Wherever you are in the world watching this webinar, because I know we have people from all over the world, and we have people have different political leaders, different announcements will cause different things to happen in the market. So you need to be aware of those. Major incidents as well, major incidents that happen. Remember when 9/11 happened in America? We had major reactions in the marketplaces. Major incidents that happen a lot all over the time, all over the years. We have things like we have earthquakes, tsunamis, we have major incidents, plane crashes, etc. And these things all set off major shockwaves in the marketplace. In Australia recently, we had a series of bushfires which really were catastrophic. The other way that news releases can help is major buying or selling through corporate demand or supply. This is where corporate companies, big conglomerations, not actually really officially involved in finances, but they are involved in other areas of business, such as car manufacturing or other types of manufacturing or supply of products, insurance, etc., but not really directly involved with the rate of the dollar, can cause waves to move in the marketplace. So, lots of these things can happen. So if a company goes out of business, a major conglomeration in a particular country goes out of business, it can affect the value of the markets very, very quickly. So again, all of these things really are something you need to be aware of with regards to the effectiveness of your strategy. My view, and I will cover news off in a later webinar, is that you should avoid trading through news releases, and I can show you later in another webinar how you can look to see what news releases are actually coming out during the time you are looking to trade. The best things to take into account when using a strategy are very simple, and these are the following. Is my strategy possibly one that could get affected by any news releases that are coming out? Is volatility extreme right now? So when Donald Trump was being elected as president of the United States, almost 4 years ago now, that's gone so quick. Volatility on the dollar was extreme. It was going up and down all over the place. When here in Britain we had Brexit, the night of the Brexit vote a few years ago, same thing happened there. And wherever you are in the world, if you're in Europe, you have your own volatility through your leaders, what they say. If you're in America, the same. If you're in Africa, Asia, or Australia, you'll have the same as well. So all of this volatility is something you need to be aware of. Will using this particular strategy that I'm about to use at this time mean that my trade that it could go into could run over a weekend? Remember, anything running over a weekend, lots of things can get announced over the weekend, and if it does, and it can be negative, your trade could actually end up opening on the Sunday night, you're trading, or wherever you are in the world, again after the weekend in an adverse position, or even a really seriously adverse position. So be aware of that. I'm not telling you what to do, but just be aware that if your strategy could mean your trade will run over a weekend, you need to be aware of that. So, and finally, what strategy works better on what instruments? So, some strategies work better on currency pairs, i.e. the forex markets. Some of them work better on indices or equities. Some of them work on all instruments. So you've got commodities as well. You've got gold, silver, platinum, copper. You've got coffee, cocoa. All of these instruments and commodities can be traded effectively. So some strategies work better on some work on all of them, some don't work at all. And that's something you need to be aware of as well, having the ability to test a strategy to see if it works. So the best way to establish that is, of course, as I mentioned, testing. Testing is so important. Test your theory, but test your strategy as well once you've created it. So, just work your way back through your charts and see what the outcome would have been on each occasion your rule was met. Of course, you can adjust your risk settings and reward to risk, and I'll cover more of that later on another webinar to get better results. You can also change the parameters or settings of the indicator. Again, I'm going to cover that more off on another webinar. You can even change the time frame you are trading. You can even change the instrument you are trading. But remember, above all, it is your strategy. It is your business. And above all, it's your future in your hands as a trader. So to summarize, guys, today we have covered what a trading strategy is and then how to look at creating a typical one. I'm not saying to use the strategy I showed you. It's just an example. You can use it if you want. But you can now have the abilities and the elements to be able to create your own strategy and begin your trading journey with CCI Traders. And you have the ability now through the CCI Trader platform, the charting, which you saw a snapshot of earlier, is to look at some indicators and start to get yourself trading. Get yourself moving with some strategies. I'll happily share some trading ideas on another webinar with you, which is what I'm going to do very, very soon. So up next time is trading ideas and indicators and how to use them. So on the next webinar, I'm going to cover off some trading ideas, some strategies, indicators and how to use them. It's going to be in a week's time. It's going to be on the 13th of May at 9 o'clock BST. So please check wherever you are in the world what 9 o'clock BST is in your local time. But what I'm going to do on here is I'm going to not only share some ideas with yourself, but I also want you to come along with your own ideas that you've created to see how much value you've received from this webinar and really how much you've learned and absorbed from this. Because if you can start to capitalize on what you've learned, you are now on the way to becoming a successful, self-fueled and self-driven trader. So I'm now going to take any questions, so let me nip back to the portal. Hi everyone, so I'm back. I hope that was useful and of valuable insight into trading strategies and also how to create one. As I said, that's just a typical example. A moving average cross is just a typical example of a strategy that you can create. What you need to do is you need to look at your charting, and next week I'm going to start to show you the charting platform, and I'm going to show you how we build indicators into the charts and how we actually then start to put those into play and create strategies and trading ideas, and then how we can use those indicators, what indicators do, how we look at sideways markets, how we look at trending markets, etc., etc. So, today was really a stepping stone for you to move on to the next webinar. Now you understand what a trading strategy is, how to create one, and the pitfalls of not using one. And the next time, as I say, we're going to show you some trading ideas. I'm going to share some of my ideas with you. And I'm going to also share some of the indicators, some of the more common indicators that we can use within the CCI Trader platform. There's things like moving averages, there's Bollinger Bands, there's ADX, there's stochastics, there's RSI. There's quite a lot of information that we can use to get us a good steer as to where to get in and where to get out. So we've got 5 minutes or so left. There's still quite a few people logged on. There's more people joined since the last time. So just want to recap from earlier. There's a couple of things I want to show you. So for example, you should be able to see this on the screen. This is the 50% bonus on your first deposit. To open an account, you simply go to ccitraders.com. That's simple. The website is ccitraders.com, and there you can open a new account, and then you'll be able to fund your accounts, etc., etc. Now, remember, those of you watching today will also get your $50 bonus, your $50 bonus into your trading account, and you need to send an email to ccitraders.com to be able to do that. So there's lots of useful reasons why you should be watching these webinars. I've got a lot of experience and education, knowledge, and stuff that I love sharing with people. So what I would suggest, is keep your eyes open for the next one. The next one will be next Wednesday. We will send the link out I'm giving you time to write questions, guys. There don't seem to be any coming through, so um, please don't tell me you've understood everything and have no questions to come back, because I always like to leave things open a little bit. So there is, okay, there's one question coming through from William. There is in the marketplace products like harmonic scanners. When you say harmonic scanners, are you talking about something that will scan the market for trading opportunities? Is that what you're talking about? William Aruga has sent that. So is that the sort of thing you mean? Yes, there are, and I'll happily share some of those sort of things with you on the next webinar when we talk about trading ideas and trading strategies. But there are places I use certain things myself to automate trading, and there are things in the marketplace like that, and I'll happily share with you guys next week what I use. I'll talk to CCI and then we'll see if we can share some stuff with you. So yeah, making this easier, making trading easier is really the goal for everybody, because clearly you're asking the question, is there a scanner in the marketplace? Well, yes, there are scanners in the marketplace which take away the need to manually to look for this. Thank you. So this is from Gabriel. Thank you so much. You're simply amazing. Please don't say that. That's I don't like that sort of thing. I'm not saying I don't like it. I appreciate it, but I'm just somebody who's applied. Okay, guys, I've applied myself over the last 10 years plus, and I've really knuckled down. I've learned my trade, and I've had the ability to deliver that education to many people all over the world, and I'm just delighted to share with you. So on the moving average, what time frame works best? H1, H4, and D1. I'm going to cover that next week. So I'm going to cover that thing next week. That's where I'm going to talk about trading ideas and the indicators. So on moving averages, I'm going to show you where indicators. So in more depth, today I showed you a 50 and a 200 moving average. I'm next week going to show you what moving averages do, the different types of moving averages. I'm going to show you how we use them. I'm going to show you other indicators, Bollinger Bands, ADX, RSI, stochastic. I'm going to show you them so you all have a basic understanding of them. Of course, if you want more stuff like that and in more in depth, more sort of intermediary stuff, then we can talk to CCI and then see what we can do. So yes, there is certain things that work more efficiently than others, and I will share those with